All right, ICICI Lombard is the next company that we're focusing on. Net earned premium has risen by 20% year on year. Underwriting losses have declined. Combined ratio is looking a little better. Let's bring in Gopal Balachandran, Chief Financial Officer at the company, who is with us now to take some questions. Gopal, good morning. Prashant this side. So for FY25, gross premium grew 10%, net earned premium grew 17%. Can FY26 be a better year on both these fronts? And what is the growth that you're baking in on these two matrices for the coming year?
So good morning, Prashant, to you and all of your viewers. So let me just kind of put this in context. I think when we started FY25, what we had kind of talked about is from an ICICI Lombard standpoint, we expect to have an outperformance with respect to top line growth. And that is exactly what we have been able to end the year with. I think the industry grew at about 6.2%. And on a gross direct premium basis, ICICI Lombard has grown roughly 210 basis points ahead of the market. And pretty much on expected lines, I think even on the combined ratio front, as you rightly mentioned, I think the trajectory is something that we have been able to see an improvement getting delivered. And more importantly, the return on equity range that we had been talking about between that 16 to 18%, I think we have been able to kind of pretty much live up to the expectations. Now to your point on how do we see things playing out for FY26, I think across different segments, I think the road that's kind of laid down looks very, very promising. Whether you look at the infrastructure investments and logistics coming in on the commercial lines, pricing uptick again happening in that segment, health looking quite promising, continuing to look to exhibit a double-digit growth, and even motor, I think in terms of how do we see things playing out in the subsequent year, looks promising. So all in all, I think what we would kind of continue to pencil in is to outperform the industry in that range of, as we keep saying, between 200 to 200 basis points insofar as top line is concerned, and obviously a trajectory to see an improvement in combined.
Sorry, 100 to 200 over industry?
That is correct.
Okay. On combined ratio, Gopal, you managed to protect the 102.5 level. Will it get difficult to improve from here on? And could you specifically give us what are you looking at for 26?
So I think directionally, Prashant, obviously what we've been able to deliver is a consistent improvement in combined year on year. That's what we had kind of spoken about as well. And even in fact, at the beginning of the year, honestly, if you look at in our April 24 earnings call, we did kind of expect the market to be slightly more semblance insofar as combined ratios are concerned. But if you look at the 9-month numbers, the industry has actually seen an adverse development in the overall combined. In fact, it has kind of moved by about 100 basis points from 112% the previous year 9 months. So the key thing to watch out for is what direction does the market take? And in that context is how we will be kind of positioning our opportunities. But everything remaining the same, definitely we would want to see an improvement in the combined going ahead. And more importantly, as I said, the return on equity range that we want to continue to start exhibiting to the stakeholders will be within that 18 to 20%.
Gopal, I just want to focus on the motor segment a little bit because some of the broker notes this morning are pointing out how the growth in motor is maybe a little soft compared to what the expectations would have been. One, obviously, it's a straight function of sale of new vehicles, and those numbers have been a little weak. But also, what are your expectations from that business? And are you expecting an increase in the motor third-party rates anytime soon?
Yes, Surabhi, good morning to you. I think let me answer the second part first. I think third-party is something where for a reasonable number of years, I think there has been, in that sense, not a price increase that we have seen. As an industry, I think we have made representations to the regulator who, in consultation with the government, kind of notifies the price change. Thus far, we haven't necessarily heard anything from them so far. But obviously, as I said, we have made the right representations. And in case if the final notifications comes through with a price change, that's augurs very, very positive, both for the industry at large and specifically in the context of ICICI Lombard, it will be a great, great positive. But to your first point in terms of how we see the motor segment play through, again, let me just put this in context. If you look at the current year, I think the key that we kind of keep watching for is can we continue to outperform the market? If you look at it on a full year basis, the industry grew on motor roughly at about 8%. ICICI Lombard's growth was roughly at about 11.5%. So we were able to accrete market share. Your point is right. In some sense, there has been a bit of a slight slowdown insofar as new vehicle sales is concerned. But obviously, I think when you look at in terms of some of the actions that the government and the regulators have taken to kind of spur demand on ground, seems to be quite promising. And therefore, to that extent, we do expect new vehicle sales to come back, at least when we look at FY26. But more importantly, for ICICI Lombard, one of the areas that we have actively focused on is to see how we can significantly improve our existing renewals of the book that we have already underwritten. So hence, quite promising and a lot more optimistic.
You know, on motor third party, you're saying industry has made representations and you haven't heard anything as of now. What is the kind of price hike that industry is seeking in motor third party? And also, if you could give us some sense of the loss ratios there, because if that third party price hike doesn't come through, it's going to weigh on profitability, isn't it?
Yeah, so let me just again put this in context. When I said that we expected at the beginning of the year semblance to come in the market, it was also in the context of motor as a line of business. And as I said, we have the numbers for the 9 months. So if you look at the industry combined ratios on motor, this of course includes both own damage and third party. There, the combined ratios have actually moved more adverse. It has moved from 118 to 123. So hence, therefore, is where we are all kind of coming from to say that it's been 3-4 years of, let's say, no price change in the context of third party. Any kind of a price increase coming through, I think we will be very, very positive at. What that number could be, I think we will leave it for the regulators and the government to kind of decide in terms of what they eventually give out. But the good news, the other aspect that we would be kind of very, very closely watching for, Surabhi, is next year, which is FY26, happens to be the year when the IRDAI defined threshold on expense of management, wherein companies are supposed to kind of meet the threshold of expense of management to be within 30%. ICICI Lombard has always been within 30. Many companies have been exceeding that threshold. So once, if we see some discipline coming through with respect to the expenses of management, that will be a lot more positive as well in terms of how demand could kind of spur insofar as the market is concerned.
You know, since you brought up that point, Gopal, I must point out that our colleague Yash, who obviously covers the insurance space, you know him well, he put out a story a couple of weeks back on this business of expenses of management, that maybe the regulator could consider individual specific caps on commissions in order to, quote unquote, kind of discipline the industry, because the regulator seems to be feeling that lower commissions are not being passed on in the form of lower premiums to the customer. Just your thoughts on this, if you've heard anything, and what will this mean if there is a specific individual cap on commission, not the total expense?
Yeah, so I think, so again, Surabhi, again, just put this in context. I think the regulator has been very, very at it to make sure that as an industry, companies kind of toe the line insofar as the expense of management threshold is concerned, which is why they gave that 3-year glide path for players to kind of work towards. As I said, FY26 is the year when you would see those companies having the need to kind of come down within those. So that will be a key regulatory watch in terms of how companies exhibit that trajectory.
Gopal, the point is, overall cap is fine, but there are commissions and there are operating expenses. Problem is, IRDA feels that commissions are through the roof. And that is, so is that a problem if it happens?
Yeah, so which is what I was kind of responding to, as in to say that I think one of the things that the regulator will be closely watching for is this threshold in terms of how companies are navigating. So long as they are able to see the direction of change in terms of companies going down in their overall cost of distribution, of which a very large proportion of which will also be the acquisition cost that they kind of exhibit to distributors, and that will be a key positive. So hence, companies will have to actively work to make sure that they bring down their overall cost of distribution, that specifically in the context of commissions, at least in the context of ICICI Lombard, which is what I was talking about. I think we are very, very clear that insofar as the overall expense of management is concerned, we will be well within the norms. And two,
have you
and individual commissions, cost of acquisition of new business, where are you at right now?
So again, let me just put that in context. Even when the regulator kind of introduced these guidelines on long-term policies, which came into effect from October 1, clearly the intent from a regulatory standpoint was to try and see if we can get the cost of acquisition amortized over the contract period. From an ICICI Lombard standpoint, clearly we have stuck to it to make sure that at least insofar as the cost of acquisition for long-term products are concerned, it gets kind of remunerated over the contract period. So that's how we are focused on, and making sure that we kind of well operate within the laid down guidelines that the regulators put in force.
Have you heard? The story was put out about a month ago. Have you heard any? Have you heard from the regulator? Has there been any interaction on commissions in the last 1 month? For the industry, not just you.
Yeah. As I said, the regulator is very closely watching this particular space, and I'm sure we will wait for any further actions on that.
Okay, all right. We'll leave it there then, Gopal. Thank you very much. Appreciate you joining us and running us through, the results, and of course that 18 to 20% ROE guidance, which I think is a bit of a bump up as compared to what they put out earlier. I mean, overall, directionally, things are looking positive. Stocks recovered quite a bit from the day's low. I think started about 3.5 lower, is down 0.8.
On the commissions, if I got him right, reading between the lines, I think the status quo is, karo nahi to hum karenge. That's what the regulator is doing in this consultation and wait and watch period.
That is what Yash's story essentially was, that, it was a warning to health and general insurance against rising commission payouts. All right.